Good morning. This is Dylan Jovine behind the markets. Happy Wednesday. Today's Wednesday, March 11th. And we haven't talked really much about oil. And I'll tell you something, years go by with less activity in the oil market than we have witnessed in just the first few days of this week alone. It's really unbelievable. It is actually historic. And the lingering question, the big question for us is basically, how does it all end in terms of the oil market? Crude prices surged to $120 a barrel. That is a sharper and more sudden rise than even occurred in the early days of the Ukraine war, the Ukraine invasion by Russia. The price has since settled back down, but look, it's still very volatile and it seems to track the president's musings on the length of the war. And a friend of mine was asking me last night, when do I think the war will end? Who knows when the war will end? Only DJT himself knows that. But I'll tell you one thing, he's starting to signal ending is near. From his point of view, he's starting to signal that. So you could see that he doesn't have the political appetite for the war. He's hearing from people that are getting crushed, or the messaging from their constituents around the country is not good. But it's a fascinating thing because Trump might want to stop it, but Iran, we haven't seen their reaction to it yet. So we'll see how that all plays out. I'll tell you one thing. We don't realize how lucky we are in America. It's a good reminder, this volatility here, because basically the more oil you import, the worse your markets have done basically in the past couple of weeks, really. So you see European and Asian markets have gotten hammered because they import a lot. Their markets have literally gotten hammered. But I'll tell you, as I record this, where does oil go in the next 6 months? What does that look like as we record this? Oil futures are settling around $80 a barrel, which isn't 120, but it's still a 33% increase from $60 a barrel just a month and a half ago. So that is a significant increase, a very inflationary increase. And here's what history has taught me. History has taught me that these kind of inflationary shocks really have one of two directions. And what happens with them now really depends on what central banks choose to do. And generally, shocks like this that last beyond a week, but oil spikes tend to last, peak at about 3 months. There's a lot more here. And I'll tell you something, there's a note out from Henry Allen of Deutsche Bank who suggests that for a risk-off bear market, because we're asking ourselves, bull market, bear market, what does this mean for the markets? Henry Allen of Deutsche Bank says basically for a risk-off bear market to follow an oil shock, and I think a 33% increase in weeks, or in 2 weeks basically, is an oil shock. But he says that for a real bear market to come from this, 3 conditions have to be met. Number one, and I have his notes here. Number one, large and sustained oil price spike, an oil price spike of at least 50 to 100% that is sustained over several months. So that is a big warning for a bear market. Number two, a hawkish policy response. Basically, if this shock, the rise in oil, pushes the Fed to actually tighten to fight the inflation, the resulting inflation. Because remember something, oil prices spike, that sends prices of everything else in the economy higher. Does the Fed react to that by raising rates to shut down inflation? That also is the second condition that leads to a real bear market. And then, of course, the third condition is broader macroeconomic damage. Basically, if the shock is big enough to tip an already slowing economy into recession. And I'll tell you something, on number one, we don't know. Right now, oil is settling in the $80 range, which is a 33% increase. But history says for it to actually be a proper shock that's inflationary, you got to see 50% settled in over 3 months. We'll see. The price of oil actually went up 100% from 2 months ago to 120, from 60 to 120. So it's settling in around 80. The futures, oil futures in 6 months, we'll see if it goes higher. So one, we have seen a spike, a huge spike, but it doesn't look yet sustainable in the 50 to 100% range. Two, hawkish policy response. Betting markets are saying the Fed's going to raise rates now because, again, all of a sudden that higher oil price filters through everything and makes everything more expensive, which, again, with inflation already at 3%, does it spike to 3.5%, 4%, forcing the Fed to raise rates instead of lower rates? Very real thing we have to look out for. And of course, whether there's broader macroeconomic damage, the shock is big enough, basically, to already push an already slowing economy into recession. And again, lost in all this craziness, Friday we saw the jobs numbers and they were not good. Our economic growth is really slowing, and a lot of those job numbers, there's a lot of confusion from corporations. Do I make a left? Do I make a right? Should I open the factory? Should I not? AI confusion, policy confusion. The big, beautiful bill gave us some clarity, but the tariffs really reintroduced confusion. And as we always say here, as I've said before, if you run Ford or GM and you want to create a factory here, is NAFTA still the deal? Can we trade with Canada? Is Mexico now an enemy? What's going on? So there's a lot of confusion with the use of tariffs, even after the president struck his tariff deals with the countries, starting to put them on again. A lot of these manufacturing powerhouses that would create jobs to take full advantage of the big, beautiful bill are frozen in their tracks, not knowing what they should do because of the left and right of the policy, the lack of clarity. Anyway, we are keeping an eye open. We will see if this leads to a bear market. But boy, oh boy, you are living through history, ladies and gentlemen. Make no mistake about it. This has been some week for the oil market, the revenge of oil. Anyway, that's all I have. Have a good day. I'll speak to you tomorrow.